All right, it is 10 o'clock and let's go ahead and get started. Um, my name is Jeff Scott and thank you for joining today. This will be hopefully fun and educational. I don't often do live meetings because frankly, I work too hard with my day job and um, I have very little control of my schedule, unfortunately. I work with a great bunch of guys and I work for a guy named Raj that's just an incredible, wonderful person. But when he calls, I answer. Sometimes when that happens, I have to get on a plane and go somewhere. Before we start, just want to call out a couple of people around the phone. I'm going to talk about the Q tools and Sagar from Superior Profits, or I know he's got a couple different names of the company, is on. I love his Q tools. You'll see how I use them. You always get a little bit nervous presenting things when the person who actually developed them are on the line. I'm sure I use them differently. I'm assuming you guys can hear me. If you just type the Y in, if you can hear me and see the initial slide. Awesome, thank you. Yes, this is being recorded. You never know if it's going to work out, but typically when I've had flubs, somebody else has recorded it on the other side. Ron Brown is here. Ron Brown, there's something I'm very jealous about Ron. And what I'm jealous about Ron is that Ron's got a few years on me, so he probably had a little bit more time during Ian's lifetime to spend time with Ian. But Ron got to be partners with Ian for a number of years, and so much of what I've learned and the success I have, I learned from Ian and Ron. And what's kind of cool is that Ron and I often end up calling out the same types of stocks, but we have a 100% different trading approach, which HGSI being so adaptable supports that. There's a special woman on this call today, and I'm just going to give her initials so I don't embarrass her, MF. Haven't talked to her for quite some time. I'm glad she's still with us. And I had a thing pop up on my phone the other day, whether it was right or wrong, that she had a birthday, and I was thinking about her. So I'm so glad to see that she's here. Without further ado, let's go ahead and get started. So housekeeping, yes, it will be recorded as long as the recording comes out. When I use the Zoom cloud, pretty much it comes out. I will send out an email later in lieu of a weekend review, and the video will be attached. I think you've all heard me say 1,000 times, but I'm just going to say it again. When you watch a video, and I'm just going to open up anybody's video, it doesn't really matter what. A couple of things. Right here is a gear. When you click on that gear, you can change the quality of the video. All right. So I record in 4K. It's not very clear if you're watching it in 360p, and you'll never be able to see anything. So that's really simple to do. If you're watching it on YouTube and not downloading the video from Dropbox, always look under Show More, because like this person who actually has great deals, if you want to get another Microsoft Office install or something, I may have notes or links here, and those links will be a direct download. Sometimes it's hard to download from YouTube without a third-party tool that gets around their security. And then, you know, not that I get anything from doing this. If you can hit the thumbs up, it makes me know that people have not only watched it, but I should keep doing it and that somebody appreciates it. And I always enjoy the emails that I get from the various folks over time. I always try and include a Dropbox link. Let's just go and look and I'll show you what I'm talking about. So underneath the video, there's usually a link somewhere down here for the Dropbox. That will download it to your desktop. Do not watch it in Dropbox because it'll click off in 30 minutes. but that's a great way of getting it as well. All right. So today is a different day. I have had a number of questions come in beforehand. I do not have a pre-formatted stop time. This will be more of education than stock picks, although I educate by doing what I do. I'm going to have a chance to show you a little bit of how I trade and take some of these picks, and hopefully you'll learn something. I often get questions from people, what's the catch? You don't charge us anything. How can I support you? Well, here's how you can support me. Give to cancer research. That's the business I'm in. And subscribe to HGSI. HGSI is in many ways a project as much as a company from George Roberts. He doesn't spend a ton of money on marketing and growing the user base. I know that Ron and I passionately like to have great feelings. I love the program, big word. I try and grow the user base through my webinars. And then some of the people whose tools I use, we're not talking big companies with Sagar and others, Roy Kelly, and some of the things that I use. I think you support me by supporting them, and you may scratch your head and wonder why. Simple. It keeps them around creating great tools that you and I can make money with learning how to use. So I titled mine for a reason, Be Your Own Guru. I'll come back to that later. But the tools I use to trade profitably and still have a life. There's my email address, and I try and answer all emails that I get, except for the trolling ones that just tell me I snort a lot and make noises. Disclaimer, as always, is educational purposes only. I'm a doctor, not a broker. I have none of the licenses that would be necessary if I was going to manage somebody's money or tell you what to do. So this is pure education. I am independent, which means nobody pays me to say good things or bad things for them. And I pay for all the tools that I use, just like you do. Trading involves risk. You and your loan are solely responsible. And I use options and portfolio margin. Portfolio margin, to me, is a tool that Thinkorswim has, TD Ameritrade, that really gives me a lot of buying power. And unlike regular margin, which gives minimal margin buying power on options, even deep in the money options, portfolio margin gives me a lot more noose to hang myself with, a lot more rope, but it also gives me a chance to hypercharge my performance. This is one of the few programs that I am going to aggressively show you my performance. I do it because several of the questions that came to me were, does this stuff even work? And what's my win-loss ratios, et cetera. I don't know what the best way of showing you how I perform is and whether this stuff works. I do not have the interest anymore in my life. I used to take a PDF of every trial, I think day life, of every trade I took, my target, my stop, my price I bought it at, why I took stocks or options. And then when I closed the trade, I would do a post-mortem on it and understand what I did right, what I did wrong. I'm not doing that anymore. John Person, when he does his newsletter, he lists all the trades he takes. Most of them are in options. And he basically does a summary of his performance. If he's plus 10 and plus 10 in two trades, then he's plus 20. It's interesting, and maybe that's the right approach because it looks at the individual trade performance. But the problem is when you look at the absolute dollars, they vary a lot. So what I just look at is, what did my portfolio do from the beginning of the year or over a period of time? And again, I don't do it to brag. My wife hates it when I show the numbers, but I think at some point, if you're listening to somebody, you should know if they actually know how to make money or not. Although I'm sure there are plenty of great educators out there that probably are very good at something, but not making money. And I do have some inside knowledge on that. Agenda for today. I'm going to have my introductory comments, which will be longer than normal. As I said, this is more of an educational affair and not just my weekend review. I'm going to review some of my favorite Ianisms: why trade top down, the boxes, why growth matters, high jump, low jump, which is my derivation of what Ian had taught us, and then reminding you about snakes and ladders, especially as we go into what may be a weaker, higher risk part of the year. Survival of the fittest. You'll see what I mean. I have a desktop littered with programs I don't use that I spent money on. So maybe I can help you avoid wasting money by showing you things that actually do work and make money. And then a little bit of how I approach the market to find great candidates, whether it's my weekend or nightly review. And by the way, they are total opposite approaches. So I think many of you know me, although I always get excited when I see new names. I'll tell you, one of the problems with the HGSI community is that it's the same folks over and over again, which is fine with me because I got a lot of friends on this call. But it's always nice when I see new blood and new people joining, because one, the investor class, if it doesn't grow, then those of us that are invested won't have anybody buy our stock. And two, it supports HGSI and other programs. So I'm a physician entrepreneur. I hate the word entrepreneur, but it is what it is. I trained in cancer medicine. I practiced for a number of years in Atlanta. I met a wealthy individual who liked some of my ideas, and I liked him, and he had some ideas. And since then, we've built a number of companies, and some of the people that work for me are on this call as well. Our goal is to start companies in year 5 or so to flip them. And we've sold 2 to AmerisourceBergen, 1 to Cardinal Health, an offshoot was sold to Magellan Health. So I've been very fortunate there. Like many of you, I work 60 hours a week. I don't sit at my computer all day. At least I didn't before COVID. That's changed my life a little bit. And I have interests. I like to play golf, go boating, hang out with my wife and dog. I like to shop, and I'm not a day trader. I do spend a lot of time on the markets after the markets have closed. And I read prolifically. I probably read 3 books a week. 1 book I read will be historical fiction, which is sort of my favorite non-educational. 1 book I'll read will be healthcare related, especially on the economics of healthcare, which is sort of the world that I live in today. And the 3rd book is is trading. And I like to look at charts and analyze markets. That's fun to me. I am not, as I said, a short-term trader. My goal is to find long-term positions. Why? My biggest winners come from longer holdings. There is this brilliant guy, and I'm going to tell you a little story about Fred Richards. I would go to, this is how stupid I was. I would go to HGSI meeting after HGSI meeting, and you start getting little cliques of people that sit together and hang out together. And there was this older guy, he's probably my age back then, I'm in the 60s. And I always thought he was an interesting guy and he was a smart guy, but he was a farmer. Not that that means anything bad. One day he got up to give a talk in front of the room, and he put a list of his top 10 holdings. And there are companies you've probably heard of: Apple, Microsoft, Home Depot, but his cost basis were in the single digits. And, you know, after listening to him, I realized that, well, I'm not him. I can't go by percentages of companies, but the way you make your money is you hold your positions for a long time. You have to let your winners run. Well, it turns out that Fred Richards was a farmer. He was also trained at Harvard, a business degree, and I think maybe a law degree at Harvard. So I think he's probably the world's smartest, most educated farmer, and probably the most successful financially farmer I've ever met and ever will meet. I make money, many trades. I cut my losses quickly and let my winners run. I have a stop system at launch. I will review that today because it's critical. I use options prolifically. I know them like the back of my hand. At least I know the ones that I use. I don't know every option trade. Why? I only want the ones that are directional and that I can make money on. And I like my toys. I have a segregated trading account, and that I'll show you that account today. That's my model account. My goal is 500,000 profits per year. I usually start at somewhere between 900 and 1.5 million. Occasionally I'll put money into that account It usually stays there about a day, and it's either on its way to the IRS, to my to one of my insurance policies, or to buying a boat or car or something like that. So I don't use that money for trading. I use the piece I started with. This year was about 1.4. The goal with my boss, meaning my wife, is I get to spend everything above the 500 on my toys. And I find it easier to make money at extremes. I think we all do. March 23rd was an extreme, and woohoo, that's when I go crazy. Just a quick warning, the doorbell might ring, and I may have to step away for 2 seconds. I've got another computer coming in today. I just want to talk about what I mean by be your own guru, and some of the things that are on this chart, this page. As I said, I like to read. And over the years, I have read hundreds of books in how to trade. I've read about wizards and leaders and fundamentalists and technicians. And there are certain things that I keep coming back to. Like many of you, I started with CanSlim, and when somebody asked me to teach them how to trade, a daily occurrence, I tell them, start with how to make money in stocks, and when you finish that, come talk to me. Because if they're not going to read it, then I have no interest in teaching them, because it shows that they're not serious. It's a very basic book in my mind, but it introduces concepts that matter. Now, it's been improved. Gil Morales, Chris Katcher were money managers who worked for O'Neill, and they've taken it their own way. They call themselves the O'Neill disciples. Pocket pivots, Bible gap ups, voodoos. A lot of new signals came from these guys, many of which are incorporated into HGSI. They've also written a book on short selling, which I've read. Now, learning CanSlim or reading O'Neill, I still was losing money all the time until I went to a Telescan, doesn't exist anymore, meeting probably in the early 90s. And this neat guy here, Ian Woodward, was speaking. Then a few months later, he was speaking in Atlanta, and I had the opportunity of hearing him again, and I was hooked. He took CanSlim, he took his British accent, and he took his wonderful mind, and he created a better way to trade growth stocks than I thought O'Neill did. Ron Brown, who I mentioned earlier, another great supporter of HGSI and does a lot of great education. He got to become Ian's partner. As I said before, I'm jealous of that. I mean, how much time can you know, what a wonderful thing to spend time with Ian. And Ron continues to support the HGSI community, and has, he puts on these great educational programs where it's multiple months of webinars and filters, and teaches volume spread analysis and how to use HGSI. Mark Minervini, I haven't put this here before, but I've read his books. And again, somebody who wants to hold stocks for a long time. And I had to laugh because this week he had a tweet about how he bought Tandem and how great it was. And he bought it. He didn't say when he bought it, but he said he recently bought it. It's now about 100, and I put it out. I was looking at the video that I did in April of 2018. It was $6. You'll see what it did to one of my accounts. George Lee, may he rest in peace. What a wonderful guy. Became a close friend. We shared the podium. We lost George this year to cancer. He certainly missed, really influenced a lot of you on this call as well. John Person. John Person, after at least 5 years of begging, groveling, and offering to pay for the implementation myself, I got John to put his indicators into HGSI as the first paid add-on. It has made my life easier because it doesn't have the quirks of TradeStation. It's much faster, and I'm going to show you how I use those every day in my trading. Van Tharp, boy, his books are thick. Position size and money management. I use a chandelier. This is the man that taught me to use chandeliers. And hold on one second. I'm going to go grab my computer. I'll be back in a second. No. All right, I'm back. Sorry about that. I had warned you that my computer was going to be dropped off, and it just was. And then here is Sagar from Superior Profit. Great tools, great guy. Another prolific YouTuber who also is the dominant poster on the Discord site. And boy, brilliant mind. And he's got his own signals, and I'm using them, and I'll show you how. And some of you don't know is Roy Kelly. I started talking about his cycle indicator. It's actually an interesting book, and I learned from it. It's a quick read. And he was somebody who was sitting in the audience and listened to all the gurus, and he decided he could come up with his own indicators, and he did, and he made a business out of it. Actually, I remember listening to him talk, and he said, you know, he sort of was talking about how every day he'd get all these checks in the mail, and it was no extra work because the indicators were already created. It's an interesting business. I think it's better than selling HGSI because you got to support that much more. So I have lots of different things on my computer. TradeStation, Thinkorswim are the core. Both programs are powered by specific indicators and strategies. I do my analytics with HGSI and EdgeRater, the Q tools, Dr. K tools. And I just want to point this out on the bottom. I am never paid by any vendor when you buy something that I suggest or use. Any affiliate fee offered to me is passed to the purchaser as a discount. I don't know everything about everybody, but I'm sure I could say the same things about Ron Brown. But most of the times when you see somebody talk about somebody else's tools, they're getting an affiliate fee. So that means they're biased. Here's the website for HGSI. You probably already are members. If not, please try it out. Free 30-day trial. And under investing strategies are hundreds of videos by Ron and myself and others. Market context matters. And this is one of the first Ianisms. Top-down investing. The market will drive over 50% of stock movement. This weekend, what did I say in my weekend review? I'm worried about the market, but there's such strong seasonality that, and I pointed that out, and this was a very strong week driven by seasonality. Well, with the market doing as well as it did, I would assume you made good money, maybe until the last 5 minutes on Thursday, when I suspect people were getting ready for a long weekend and buying some protection. I think half the movement on Monday will be determined by whether the market is up, down, and how much. Industry group matters, maybe 20 to 30% of the time. And that means being a great stock picker. And I think I'm a pretty good stock picker. I think that's my strength, that being a good stock picker is probably only accounts for 30% of my success. So the market determines my stance. Am I long, short, margin, or in cash? When I say margin, it means I'm really long or really short. I look for my favorite setups in the top industries. I look at bottoms up for top stocks, both short and long, and I use different tools to gauge what's working, and we'll show you that as we go. If you see a slide that has the red, green, and yellow triangles, this goes back to the early days of Ian. Ian gave me permission multiple times to use these slides, but I always want to call out where they came from. So the story is this, and no, I wasn't there. I was there for a couple of the meetings, but no, I won't take any credit for that. Ian would hold something like this in the pre-Zoom era once a month at the library in Palos Verdes Estates, California. He would have a group of people. Some of them, like Mike Scott, are very active on some canceling boards and are very smart in themselves. And in that room on their monthly meeting, they would pick the best stocks in the market. And then every month they'd come back together, hey, how you doing? And they'd pick 10 more or 20, whatever. They'd look at the market again. They had somebody that kept track, and that person kept track. You don't know today whether we're in a strong, mixed week, or weak market. But 3 or 4 months from now, you could probably characterize the market we're in today. So they had somebody looking at their list of stocks and looking at what happened at a 20 or 40-day period of time, broken down by type of market. And there are some very, very powerful stories here. Assume 20 days is 1 month of trading, 40 days is 2 months of trading. 20-day returns in a strong market by this group of very good stock pickers was over 100%. In a mixed strong market, it was close to 100%. Same folks, same ideals, suck in a weak market. So if the people picking are the same, if the techniques to buy stocks are the same, and the only difference between 106% return and a minus 50 is the market, markets matter. There's another message here, and this sort of goes against my longer term holding philosophy. In a strong market, take profits early, because when they watched over the next month in both a strong and a mixed strong, the profits, you gave back some. So I have a tendency, as you see, to rapidly take half off the table on a profitable position. The other thing is, in a really bad market, time is not your friend, because in a very weak market, it can get worse. So waiting for the market to bounce may not be the best part of managing your money. This is a critical slide. That's why I keep using it 20 years after Ian first presented it. Stock patterns are cyclical. Where are we? If you don't know, you shouldn't be trading. Now, you don't have to be exactly correct, but you got to have an idea. And not only where are we in the market, where are we in the industry group you're looking at, and where are we in that stock? Because this is a fractal pattern that occurs in each of those, and I don't care what time frame, I can find this pattern over and over and over again. March 23rd, we clearly were sitting down here and had a rip-roaring buy signal. You could have thrown darts at the newspaper and bought the worst thing in the world in the setting of a shutdown economy and pandemic like airlines, casino stocks, and cruise ships, and made money. That was the easy days. Was it February 21st, whatever day the market rolled over? We were sitting here. Now, we were sitting here a lot, and if you're a serial listener to my videos, you know that I often say, yeah, we're here again. And, you know, every time I think we're going to roll over, we go on to higher highs and we do it again. Well, what happens is you get this pattern repeated over and over again in making an uptrend. We are clearly in stage 3 right now, with a tendency to go a little bit higher, at least if you're the Nasdaq. But if you're the other indexes, you could make the argue that we're in a phase 3 or stage 3, and we're getting ready to drop. So I think that we are somewhere, maybe not in that red circle yet. Maybe we entered it at 355 on Thursday. That's where I think we are. Now, after the market started falling, you knew we were in stage 4, and hopefully you got out of your longs, bought some contra ETFs, shorted the market, went fishing, got out of the market. But this is it. I mean, this tells me what's going to happen. And based upon that chart, it tells me what I should be doing. Now, we have been living for the last month and a half here, 2 months, March 23rd, it's April, May, June, 3 months. And to me, we've sort of crested. So I've been very, very, very long, but I have started to get a little bit more defensive. Now, the first thing I do when I get defensive is I start taking profits. I start looking at my options. And if I have options that are deep in the money, I want them to be less deep in the money. So I take profits. I'll talk about my up and out strategy on my options. And I start to raise cash and start to get smaller positions and maybe even sell premium. Now, when you see my portfolio, you guys are going to laugh because I got a lot of positions. But most of the positions are positions that I took half my profits out or half off the table, moved my stops to break even, and now I'm in a trailing stop where they don't count against my risk because I've already made back my cost. I don't like to lose profits, but I have a very strict policy of how I manage my money and my risk. So I use different strategies based upon where we are in the market. Ian's boxes. This became a topic of contention between my buddy George and I. And when I kept saying George Lee, God, I love that guy, I miss him. It only works off the bottom. That's not really true, but it's the better thing to say because it really works amazing off the bottom. And what the boxes say is you can define boxes of stocks, 1 through 9. I don't talk much about consistent turtles, which used to be the Gillettes of the world and cash. But you define these boxes by current earnings percent growth rate, looking at the last 2 quarters of year-over-year growth and annual earnings. And you find that stocks that are growing 100% quarterly and over 50% a year, they should double in 1 year. You have box 5 that doubles in 2 years, box 9 that doubles in 3. My favorite box is box 7. Why? They're ripping it. They're roaring. They're doing great on earnings per share growth, but they must have stubbed their toes in the past, and therefore they are a turnaround stock. So you can easily, in HGSI, build these boxes, and if I have time, and if I forget, somebody can ask me to do it, I will show you how you build them. I did do this in the weekend review last week because I had a question. Now, what's the proof, sorry about that the boxes work? Well, let's go back a long time. Ian taught us this in 1992. He was using it before then. 1992, 93. And I'm not even going to try to sound like Ian. I wish I could. I loved his accent. He would say, he's sitting at home and he's noticing these stocks are starting to break out. He knew that the market, which was at a bottom, was turning around. So these were stocks that made it into the boxes from September 11th to February 12th. Notice the performances in the various boxes in I have to be more careful, Jeffrey, hold on. Look at the performances in a 5-month period. Performances that we've been seeing of late as well, frankly. But how impressive would you like to see your portfolio go up with stocks in 5 months up 100%, 60%, 30%, 30%, 80%? I mean, what a great move. So that got me paying attention when he talked about his boxes. Well, maybe it was a one-time wonder. 98, 99. I just picked some of these out from his old decks, and then I'll show you where we are today. Same definitions. These are just the top 3 in each box. There were 190 that went into the boxes. Average performance of these 190 stocks was plus 67%. Between October 15th and January 22nd. That's 3 months and 1 week. 67% return, throwing darts at a list of stocks that had high growth performance characteristics. How about 2011? Box 7 stocks up 106%. From 9/1/2010 to the market peak on April 29th of 2011. Box 1 stocks up 125% over that time. Even box 9, that should be the laggards, were up 50%. Now, actually, let me say this, S&P was up 24% of the time, so they outperformed the S&P 500. And it was filtered by 2 things. You took the entire universe of stocks, you filtered for ERG over 255, and then the next thing you did is you created the boxes. And this is automatically done using the slices program in HGSI, and hopefully somebody remind me if I forget to do it later on when I'm in the program. ERG, if you're a newbie, EPS rank, 0 to 99 possible. Relative strength rank, 0 to 99 possible. Group rank, 0 to 99 possible. Take the first letter of each one is ERG, and the max you could be is 297. The least you can be is probably 3. So if your ERG is 255, that tells me that your earnings must have been strong, that your relative strength compared to the rest of the market must have been strong, and your group must have been strong. Theoretically, you could be 99 on E and R and then be 60 and still get to that level on group. So 2 out of 3 have to be strong. It's an HGSI, but also similar to a ranking in IBD. Oh yeah, what about today? I do and again, I should have a parking lot that I write these things down. So let me do that. I'm going to put in my parking lot boxes. I'm also going to put down group performance analysis and saving the database. Okay. I save the database so I can go back in time and say what the market looked like from a fundamental perspective on a given date. So on the weekend preceding March 23rd, I have a snapshot of the database. So this is not a box 8 on what's today's date, July 3rd. These are stocks that it could be, but they were box 8 on the weekend approaching March 23rd. I don't know in advance when the low of the market is, so I have to do every week. So I use the fundamentals and pricing on March 23rd or coming into March 23rd. I looked at performance of the boxes between March 23rd and February and July 3rd. So we're at 3.5 months. The S&P, which has done amazing, is up 40% from the lows. Unbelievably great performance. You really hope that you were long during this period of time. Box 8's up 92%, box 4 is up 84%. If you had ERG 240, fundamentally strong stocks, you were up 46%. So the message to me is the box still works, folks. The box still works. Now, it may just be that the boxes represent high growth stocks and high growth stocks work off the bottom. Who cares what it means? Box 8, 4 to 1, winners to losers. Box 4, 11 to 0. Box 6, 16 to 0. Box 9, 8 to 0. Do you see a pattern here? You want to buy box stocks off the lows. Now, I've looked at box stocks at various times, and it really depends on whether growth is in vogue or not. Growth appears to be in vogue off of the initial move off of the bottom. Cool stuff. High jump bar. God, I love Ian stuff. And no one would say it better. We'd hear stories about his wife's rose garden and rust and all kinds of rigmarole. I mean, it was worth it just to hear his stories, to go to his meetings, the stories and his commissariat, his family, the food. How do you tell if a stock is extended? We all know what extended means, but how do you measure it? And how do you compare among groups of stocks what's extended? Well, Ian gave us the high jump. I think I made it better. And I say that even though Ron's on the phone and Ron's a smart man. Ian taught us, this is the measure that stuck with me. You measure the extension of a security from its 17, the 50, and the 200-day moving average. So imagine a stock's in an uptrend. In an uptrend, you are above those moving averages. You add the price minus the 17 equals X. The price minus the 50 equals Y. And the price minus the 200 equals Z. You add X, Y, and Z together, you get a number. That number means nothing in any other stock. But if you have that number calculated going back to the left for your given stock, if the highest that number ever got in the last 2 years, 1 year, 5 years was 185, and your stock today is 184. Do you think your stock's likely to pull back because it's as extended as it's been? Absolutely. And then I combine that with something like a red candle high, which we'll talk about, that tell me that this stock is likely to reverse. Now, Ian never talked about the low jump bar. So I decided if it works extending to the upside, it should work extending to the downside. So think about a stock that's been in a downtrend and is extended to the downside. The 17, the 50, and the 200 are below the baseline. Therefore, you have price minus the 17 will give you a negative number. Price minus 50, a negative number. Price minus 200, a negative number. And therefore, the more extended to the downside, the deeper the negative number you get. The same philosophy of how I look at that it applies. And if you look at a stock that's basing, they're going to have a very low high jump number. Could be a little positive, a little negative, could be mixed. So I'm just going to pull up TC 2000. And George sent me an email not too long ago and said, Jeff, I'm going to build that for you in HGSI. George, I'm waiting because to me, square. So I basically am running real time all day long this chart here. I'm looking at on the bullish side, these are stocks that are trading at the green candle low, at the low jump bar. So what I did is I used telechart, telescan, whatever, telechart, TCNet, and I built an indicator, meaning I paid somebody money to build me an indicator because I have no aptitude when it comes to that. And I said, take that math I just told you and then look back 200 or 400 or 600 days, user choice, and tell me what percent of the highest extension to the upside or the greatest extension to the downside. At the 95% level, let's draw a red line, meaning I'm extended to the upside and I'm going to come back down, or a green line where I'm so beaten up, I'm likely to bounce. And so you could see that when the stocks hit that red line, they're extended. And guess what, folks? They come down. When the stocks hit the red line, they come down. And when the stocks hit the green line, it may not be that day, but they reverse. And then what I want is I want a combination of a reversal bar, the green candle low or the red candle high, and I want to be able to build a list during the day. Now, here is my stock of the year, well, not short, for the last couple of years. And boy, oh boy, make my day. I'm sitting at home one day and I've got this neighbor, all right? And she's trying to figure out how to be a trader. And she's making all the mistakes that I made, which was, am I a short-term or am I a long-term trader? And she's trying to do both at the same time. But somehow she had gotten into Shopify very early on. And she kept telling me about this great stock, Shopify. And I'm looking at it in here and I'm looking down here and going, I can't buy this. It's too far extended. But showing that great leaders can get more extended over time. Then one day I'm sitting at home and let's see, when we get to the right point, hold on a second. I messed up my, that's 2020. I wanted to get over here. I'm sitting at home and on my scan, I have Shopify has hit my low jump bar, meaning reversal imminent, buzzer sounding in my ear, and it had a green candle low. What is a green candle low? A green candle low is a 1-bar reversal or 2-bar reversal. The stock has been in a downtrend. The stock opened up lower than the prior close. The low of this day has to be lower than anything in the last 10 days to the left. It closes higher than it opened, therefore is a green candle. So stock's trading down. In the morning, it opens lower, trades up on the day, gives me a green candle, bounced off the low jump bar, I'm in, and boy, oh boy, that's a run from 380 to over 600. Then it did it again. Not as pretty here because the market was challenged. It's $1,029. I sold off the last 3,000 shares of Shopify I owned this week on Tuesday. It sort of went on the old adage of, you know, hogs getting slaughtered. So if I look at current markets, green candle low at high jumps, that's stocks and market ETFs. Let's look at common stocks. I just want to decide which one I want to use. Just look at my universe. Let's see if it's built in here. In the U.S. common stocks, there are no stocks meeting green candle low at the low jump. This is an extended market. There's a few stocks that are at the green candle low and they go on a watch list, but none of them have given me a reversal candle yet. We're an extended market, U.S. common stocks. This is one of my good holdings right now, and it signaled that I need to protect myself. So I actually have bought some puts on it this week. It's at the high jump bar, and it had a red candle high. What's a red candle high? A red candle high means the stock has traded up on the day and closed lower than the open. And it was the highest high, I think, in the last 20 bars. And it hit the high jump. So look at all the stocks here in the U.S. common stocks that triggered the high jump. Now, I typically filter down the common stocks and look at only certain stocks with price and volume. I love Ian. I love what I learned from Ian. I made it better. There are not many things that I'm going to say that I made better than what Ian did. In HGSI, you can plot either the individual here or the sum, and clearly every time it peaks, you could see that the market pulls back. The absolute number doesn't help me. So what I did in my version, and I did it in lots of programs. Here it is in TradeStation. I just look at a percentage of today's value, what percentage of the highest high, you better believe there's 100% as we're peaking here the whole time up. What percentage of the highest high am I today? And it says here that I'm 9.82. And I can look at that in radar screens, market watches, etc. And it says here, I monitor this in real time. And I think the TradeStation, the TC2000, TCNet is my best implementation. I've been scanning for low jumps. This is Genesis, which I hardly ever use. You can see this is back in, November 2018. And I painted these little asterisks when the stocks hit my low jump bar, and red asterisks when it hit my high jump bar. This is nothing new. It's something I've been using. Another Ian-ism, and one that makes money over and over again. He'd stand at the front of the room and he'd talk about all great stocks will pull back to the 50-day moving average, and the really good ones will pull back to the 17-day. I'm not good. Okay, guys, I'm seeing a lot of questions. I will get to them. Yep. I like buying at support. To me, the 50-day moving average is support. So if you have a stock that's been doing this, heck, every time it pulls back to the 50, you want to buy this stock. This is Micron, which has been obviously a big mover. Last of this section, don't play snakes and ladders with your retirement money. Now, of course, you're thinking to yourselves, snakes and ladders? We played chutes and ladders growing up. So yeah, but that's, as Ian would say, unless you grew up in bloody England. And if you think about the game, you're sitting there with your friends, your siblings, your parents. In my case, I had few friends, so it was always my parents. You roll the dice, and you hit a 9. And it's like, woohoo, because the ladder takes me up to 31. I roll the dice again, and I get to 37. That's okay. And I keep playing. Then I get up to 64. 64 is okay. I only go back down to 60. But if I landed on 62, ooh, back to 19. And the moral of the story is, it's a fun game to play with your grandkids. Don't play it with your retirement. And boy, my head is hard as rock. It took me years to figure that one out. I don't have to make money in the market every day, every month, even every year. I just better not give up much of my cash. And I have to limit my exposure on the downside. Well, I asked for questions, so I'm going to respond to some of the questions as we go. One of the questions was, Jeff, I love watching you, I'm ad-libbing there, and all that stuff. You have so much fun, but I'm just a normal guy. I've got 50,000 in an account. Does what you do actually work with smaller accounts? So, yeah, back in April 2018, people were asking me the same thing. So I started a model account, a cheap account. I use TOS for my main trading because of the portfolio margin, and I love Thinkorswim. I use TradeStation to find the stocks, but I more likely trade it on TOS because the other thing that I like about TOS is that their iOS platform and their Android platform are just incredible. I had an account sitting at Charles Schwab, and it had $50,000 cash in it, and it sat with $50,000 cash in it for years because I just forgot about it. So I decided when I was doing a program in Orange County with George Lee in April 2018 that I was going to play this account. I decided to prove I could trade small. I set rules: no margin. I would not add money, but no limit on what I take out. Goal is to find big winners, take profits as I went, but let a portion of this run. When I ran out of available cash, I could only add a stock by closing an existing one. All trades were placed after hours with buy stops. I did not use leverage, and no protection besides the stop program that I use, meaning I didn't buy contras, I didn't buy puts. I started with options, and very quickly it grew. Does this work with a small account? I'm not making this up, and I'm happy to have somebody audit it. As of close on July 2nd, 2020, that $50,000 is now got a market value of $297,170. You can see my cost basis here at 54, which really isn't related to the 50 because I was buying and selling the whole way up. And my gain on my current positions is 242,000, which is 443% in 2 years. Oh, by the way, I also bought some toys. I took out 160,000 between long-term and short-term gains. So you add this 159 to this 297, and among friends, I turned 50 into 450, ignoring an account with very few trades in 2 years. It can be done with a small account. And now, just if you look at the 3 holdings that I have, I bought Tandem at 693. Okay. I have sold Tandem the whole way up and bought it and sold it. And that's a lot of the money down here. Tandem is the one that Minervini called out because it was crossing 100 this week. C, I bought C at my effective price on C is $35.27. I was options on C, and I converted the options to stock. What I did is I sold everything but 1,000. So I sold 40 calls and took the profits on the 40 calls and bought some stock. Axosome, I got in at $12.50. All three of these were presented on some of my weekend reports. Now, this is a risky portfolio. By the way, I just left them in during the pullback because they held up better than I thought they would. This is a long-term account. I'm very pleased with this, but I think it answers the question of, can you make money on a small account? I have never put $1 for trading into this account since the day I started, and I've taken out a lot of money to buy toys. Comment 2. I got a couple of questions that came in and said, it's all great, Jeff. It looks like you know what you're doing, but do you have any back-tested results? And I scratched my head, and I thought first, the joke, yeah, I only give those to the paying customers, but you all know there are none of those, so that doesn't count. So what I decided to do is, I share some of my portfolio results. I understand the question, but I don't have a specific strategy. What I present are stocks at good buy points from both a top-down and a bottoms-up perspective. I share my results at minimum quarterly, sometimes monthly. My wife gets mad at me because she says I'm bragging. She's right, but I'll show you my bad times too. I get positive feedback. Even today, someone called me up and said that she was working in a hospital in COVID Central Dallas, and she wasn't going to be able to watch this because she had to go to sleep. And she thanked me for 3 recent positions I turned her on to. I gave Tandem on April 8th, 2018, when it was less than $6. I can't help it if people don't buy it. If they buy it, I appreciate when they tell me they did. I watch my P&L daily, so I know if I'm making money, but I don't look at an individual strategy level. And then I have the issue, does it matter if it's stock or options and what the market's doing? So the answer is no, I don't have back-tested results. I can tell you results matter. So from January 1st, 2020 to June 30th, I started with a little more in the account, but $250 went to the IRS, $250 went for my annuity, and then I live off this account. So when I take out the checks out to the IRS and my annuity, I had 1.4 million. It was down to 1.4 very quickly, probably by the 15th. My P&L for the 6 months, and you could see the only thing that matters here is the green here is $963,190. That means a 68.8% year-to-date return. Annualized, that's 137.6. And as I mentioned before, I have portfolio margin. If you want to use a microscope, you have my long holdings here, of which there's 2 that are stocks, the rest are options. You have shorts, you have contras, you have puts and calls. I have a very, you might think it's messy, but I can tell you every position I have, what my cost basis are, and what my strategy is. This makes me really nervous. Remember the number here, 963,190, and this is on June 30th. Here's July 2nd close, 1.165. You don't make $200,000 on a $2 million portfolio in 2 trading days in a normal market. The stocks that I own melted up, and I own a lot of technology. Therefore, as the day winded down, let me just show you. Somebody asked me, what do you mean you did some short-term protection? As the day winded down, I took some shorts on this. I got a spider bear put spread. I got long the SQQ, long the TZA, long the VXX, long the SDOW, and long FAZ. If the market trades up a lot on Monday, I'll probably cover them. They are short dated, they are spreads, and the return, risk to return on these is very affordable because they're short duration and because I spread out some of the risk. But I like protection on my portfolio. Another question. I noticed in the John Person Paul, sorry about that. In the John Person package, that you have these things, index, industry percent, and last conditional change. Do I use them in filters, charts, or decision making? Great question. Thank you very much. So index over industry percent. What I wanted to understand is if I believe that a John Person buy signal is a meaningful signal. And I was looking at a stock and I saw that in the stocks industry group, everything else was on a sell, yet I'm looking at buying that stock. That would tell me that's probably not the strongest industry. So what I did is I created 4 signals, 2 bullish, 2 bearish. The last buy and the last sell tell me give me the last signal that occurred on that instrument, or that instrument, and that could be 1 day, it could be 17 days, it could be 6 months. So if XYZ stock in that industry is on a buy, all it tells me it's on a buy. So when I see that, those first 2 lines tell me that within this industry group, which is biotech, and the market close on Wednesday, that 45% of the stocks are in a buy and 55% are in a sell. That's all it tells me. It tells me it's a median and neutral, okay? Then the signal buy, signal sell tell me what occurred today. 15 buys today, 7 sells. So that tells me this is a industry group that was in the middle, neither bullish nor bearish. And then today, all of a sudden, 15 to 7 stocks were bullish. That tells me this may be an industry group that is favorable. That's all it tells me. That's all I use it for. You can see this in a chart. You can see it in a warehouse view. I do use it in a combo, which is ranking the best stocks to come to the top. But unlike others, I'm more filter driven in how I look at things than combo driven. The other question, also a great question. John Person's last conditional change, I can't do it justice in defining it. But when you're in an uptrend, so let's see if I can, let me go into a chart. What chart is this? Allogene. So we'll use Allogene. A-L-L-O, okay. Folks, when I say send me questions, I'm not just giving you lip service. That's what I do these for, is I want you, look, a lot of you have bought shit because I said I like it. I don't want you to be mad at me that you bought stuff that you never use. So I want to share with you how I use these things. So as I understand it, a last conditional change is when a stock takes out the prior low in this case, it creates a last conditional change. So it was in an uptrend, in an uptrend, in an uptrend, and this last conditional change here trails every time there's a new closing high. It trails up here, and when I take out that last conditional change, thinking about that as a trailing stop, that signifies that I've gone from a bullish, where it's green, condition in the market, to bearish, and I immediately placed a bearish last conditional change. That bearish last conditional change will continue to trail down with my price until I get a bullish move that takes out the bearish last conditional change. When that happens, I place a new green last conditional change, which will continue to follow up, okay, until I have a price move that took out that prior change. Now, this one did for a day or for intraday, and then it kept on going. So a reversal could be a stock that, let's say it got a new person buy signal, on a daily, it's in a person buy signal on a weekly, and it took out its bearish last conditional change. That is what John refers to as a trilogy buy. Oh, Jeffrey, you dumb. I don't have it set up here. All right, so let me find it this way. I want to show you that in action because it's a good one. You don't have this unless you bought John's stuff. Yes, I know it's expensive for HGSI. Nothing to do with pricing. I had to do with getting it in the system, and believe me, I've made a lot of money because it's in the system. So I want to look here at new Oriental education and technology. And I want to look at the right edge of the chart, and let's make it bigger. Okay. So trilogy buy. I've got a person daily buy signal. If I switch it to the weekly chart, I am in a weekly buy. These are really good trend trading, trend change signals. Look how long this buy signal ran, from 6, 7, all right? And of course, you would have been stopped out, I would hope, over here. But you would have had a 7-month trade. That's where you make your money. It's not this one-day wonder shit. Excuse my French. So trilogy buy, both daily, new daily buy, in a weekly buy, and the move was sufficient to take out the bearish last conditional change. If I look at the filter here, I put in my price and my volume. It's got a PBS buy that occurred today. The last weekly equals a buy. I don't care when it occurred. And the percent of the closing price to the last conditional change bearish has got to be greater than 0. It means I closed above the last conditional change, and it's not an ETF. So I am scanning for great stocks when I scan for that John Person trilogy buy, probably his best buy signal. And by the way, for those of you who live in TradeStation and have no interest in buying his indicator package, that's your business, not mine. The trilogy buy and sell signal is also calculated in TradeStation. But you have to buy John's Person's package in TradeStation, and these are updated. Yep. Okay. All right, so I think I took care of that. So over the years, I've built a toolbox from observing others, attending Palos Verdes meetings. God, I miss those meetings. Ron's videos, and lots of other books and videos that I can find. And I've listed some of the different things that I use and things that I talk about almost on a daily basis. The Q tools, the Dr. K tools, and the Trend Pro cycles are new, and they're not available in HGSI. So I will try and show you some of how I use them as we go through. We are sitting now at 1 hour and 9 minutes, and I'm still in the PowerPoint. I knew that would happen. I plan on staying until noon, and then we'll go from there. So it's not rocket science. It really isn't, and it's not as hard as it looks. I took this picture here from Turning Point Analytics. I've been talking to the proprietor, Jeffrey Marcus, and giving him a little advice on what an individual user might be willing to pay for. At the end of the day, there are 6 patterns, 3 bullish, 3 bearish, that I care about. Maybe I could argue that there's 8 trades here. When I'm bullish, I'm looking for an uptrending market that pulls back to support and then moves up. All right, this is a chart pattern. I have programs in TOS and TradeStation that automatically paint trend lines. Sagar Superior Profit does a great job of that. I have a zillion momentum indicators that I like, all right? I could be kahunas, pocket pivots, PPS signals, all different things that tell me the time is now. This is my favorite trade because I'm a bull at heart. The second bullish trade, it's a higher risk trade because you're buying a stock in a downtrend. But the stock breaks out above its prior resistance. And what happens is what often was resistance on the downside becomes new support on the upside. And just as this chart shows, I don't necessarily want to buy it the way it breaks out because they always retest. I want to buy it when it moves up after the next little pullback. Pullbacks in an uptrend, breakouts in a downtrend. The third bullish trade I'm going to look for is a channelingstock.com. That actually was a website back in the heyday before the market collapsed in 2007 and 8 when everybody thought they were brilliant. And I look to buy things when they bounce off support. The fourth bullish trade, which really looks more like this trade is when it breaks above resistance, retests, and continues to go. And it actually looks a lot like this when it comes out. That's the only trades I care about, folks. I just want to find them and find them when they're young. Bearish, I'm going to look for a downtrend that retraces and short it again. Why in the world does anybody want to go long these retracements? Only those that want to lose money, because the timing is too short and you have to be really good and not have a life if you're going to make money on these short moves. I want to make money on the dominant long move. How about an uptrend that doesn't bounce and breaks down, retests, and fails? Breakdown from an uptrend or from support in a sideways move. And then technically, a breakdown from this support here. So a bounce at resistance or a breakdown from support. That's the only trades I care about, the only trades I take, and I got good at them, finding them and managing them. I use the tools to find my setups. These are the tools that I use, not necessarily updated fully, but you could see Dr. K's Laguerre RSI for a change in direction. I love Go with Flow. Oh, do I love Go with Flow from Sagar. These are the trades that I take. And then I'm going to answer a couple questions. Long stocks, let me just give you some thoughts. Cheap stock, I'm going long. If I want to turn something into a long-term play, I'm not going to have it be a call because I want to take the advantage of long-term capital gains. But I like entering things as a long call. I may combine a long call with a long put, which is a synthetic long, which basically gives me the stock for free. And I'm going to show you this in a few minutes, but carries the same risk as buying the stock. I might want to combine a synthetic long with a protective put, which turns it into a cheap synthetic call with all the upside and limited downside. I use verticals when the calls are expensive because it allows me to spread out some of the price and reduce my cost. And I apply butterflies, but usually not at entering, and I use a modified butterfly. They're not equal wings. The bearish trades look the same, just the other way around. And as part of my money management and risk control, I look to take out the short position on my Scott Synthetics once it has lost 80% of its value. And most of my downside resides in that position, so I exit when I'm able, and this also frees up margin. Let's ask a couple of questions that we have here. Will you send us the recording later? Yes. Myrna, I'm so glad you're here. Oh, I can't tell you. Can't believe we live so close and we never see you. But I guess I don't see anybody now. Yep, this is the formula for the high jump, or the low jump. And then I basically set it sort of as an oscillator where the highest high going back X bars is set at 100%. The lowest low going back bars is at minus 100%. And then I take the individual value and it oscillates between those. Have I back tested the low jump with Roy Kelly's indicator? Nope, but that's a really good idea. So I'm going to look at that. Thank you for the idea. Why 17-day? It's Ian. And the story was, I remember correctly, everybody else in the world uses a 20-day. So if I'm waiting for the 20-day to cross above the 50 or the stock to pull back to the 20-day, I can front run them by using the 17. That's all I remember, and I've been using it forever. Can I get George to add Jeffrey's high jump indicator to HGSI? Yeah, I can. I've asked. He said he's doing it. Hopefully when he watches this video and he sees how beautiful it is in TC2000, he'll do it just because it does exist in EdgeRater. And I had some questions about EdgeRater that I'm going to show you as well. I had Chris build this in for me. And I use a limited universe. I don't use all stocks. And I could look at greatest to least. There were no high jumps to the high or low in my universe. What's better about this? All right. And let's just show you how I would do it. Template. Let's find my high jump, low jump. It's in my favorites somewhere in here. Come on, here it is. Let me change to all stocks. It's a bigger universe. Oh, do I not hit? It's updated through the second, right? So it's good. Okay. Let's hit run. It's a relatively quick thing. Ha. Yes, Chris, you asked George too, because more people get it. All right, this will be done in a moment. Hey, Nagesh, hope you're having a good day. All right. So when I expanded it, I don't know why Etsy was not in my prospecting. I'm going to have to go back and look at what I limited there. Etsy, high jump and greater than one. So Etsy is an extended stock. These are the extended stocks based upon that list. In TC2000, I only have them matched with red candle highs. But in EdgeRater, I had Chris build me in some other bullish and bearish signals. Let's look at Etsy very quickly. And let's go to this is just one of the many, many workspaces I look at. And, well, somebody asked about the Roy Kelly. So here's a short-term row. This is a major cycle top in Etsy here that painted on Roy Kelly. I thought I had, let me add the high jump here. It'll get cluttered, but what the heck. This is obviously not my usual presentation, and about the only time I normally do what I'm doing today, frankly, is when I'm doing a live meeting and I'm trying to drum up interest because it doesn't break even until I have enough people show up at the meeting. So there's value. So I try and promote the meeting. And I can see on the high jump, it's at 98.34. So the high jump correlated here with Roy Kelly, and it also has some MACD divergence, which is what that, I think there's a dot there. So Etsy is extended. So I use, now you're probably asking, let me go back and say, why is it 100 here and only 80 there? Because I have to redo my trade station indicator because this one runs from 0 to 100. It doesn't go from plus 100 to minus 100. And if you only look at the positives, it would be at 100. But if you look at combining the positive and negatives with the negatives of 0, that's the way it comes out. So I'm going to revise. Frank, maybe you and I can talk about that and you can help me put that together. I know you're a whiz at TradeStation. So it's there in EdgeRater as well. Okay, options. I'm not here to teach options today. I'm going to show you 2 potential trades on Monday and how I look at the various options, and I will explain how I trade them. I'm getting a lot of texts and emails from folks, and so I'm laughing a little bit. But I also got to tell you, it's hard to keep up. So somebody who I respect a lot said, check my email. So for all I know, I'm showing something I shouldn't show. Let's see. One second, I'm just looking, because he wouldn't say that unless I needed to do it. All right, it's not showing up yet. So I'm looking every email since 10, and I don't see it from that person yet. And if it went to spam, I don't have a chance to get it. All right, back to the story. So I'm already in CrowdStrike. I'm not buying CrowdStrike up here. It's too extended. That said, if you look at some of the major movers, they've had really long uptrends. So I drew some easy trend lines here. It's sitting on the 17-day moving average, or at least it was yesterday. And at one point, it's been a great,
Hello?
Okay, now Siri's talking to me. All right, yep. Ron showed me some of the Woodward and Brown user groups. Look, growth stocks work during this period of time. And when you look at groups of great stocks, you made money and you outperformed the S&P. So CrowdStrike's in a clear uptrend. The time to buy it was right here. And that's when I got in. Yeah, it would have been better to buy it here, but why would I have seen it there? I had started an uptrend. I pulled back to support, and I broke out, and I had my momentum signals. I bought it in the 60s, early 60s. Let's say I wanted to buy it on Monday. Its closing price on Thursday, which is Friday, is $108.30. I usually buy my options either at the money or in the money. This is Dynamic Trend, which is made by the guy that used to do, what's it called in Signal? Advanced Get, Joseph. I can't remember his last name. It'll come to me. VectorVest licenses it. I probably should buy it directly from Dynamic Trend. It's cheaper. So here's my chart. So let's say I want to buy this long because it's coming off the bottom of its trend channel. It's at $108. So I could either buy 105 or 110 spread. All right, so I go to my spread select, and I'm at the verge of killing my program. All right, I'm going to use black line. Let's use black line instead because, nope, we don't have to do that. I can change this to crowd because the way I got it set up, everything's going to change. And I'm going to have to redo my favorite one, which is over here because it's not standard. And then it changed. Okay, so I want to buy it. Last price was 108. I'm going to start with the strike at the money at 105. I'm interested in here, in this case, only long, but I'll show you, I only selected long trades. My minimum range would be $5, which is what I'd already picked there. That's probably not enough. I probably should have gone to $10. These are not going to adjust on that. I went into select spread and I picked the different trades that I'm interested in taking. Long stock, long call, short put, covered call, bull put, and synthetics. Down here I have Jeffrey's, what I jokingly call my chicken shit synthetic, which some people call the Jeffrey synthetic. And what I really like about it is I've even got people like Sagar, who knows a lot of what he's doing, to actually start trading with this. So I'm just putting it together real quick. And I'm going to explain to everybody what they are. Why is it doing? All right, I'll go to 105. Okay, so buying long stop. This is the profit and loss curve of buying stock long. We're talking 100 shares. So 100 shares of $108 stock is going to cost me $10,830. As the stock price goes to the right, gets higher, my profits go up. As the stock price goes to the left and goes down, my losses get greater. Every time you buy a stock, you are buying this P&L, Tom Joseph, thank you, this P&L price loss chart. Every time you buy a stock. Your maximum profits to infinity and beyond. Your risk, the price of the stock. Now, we both know you're never going to ride a $100 stock down to zero, but theoretically it could gap down tomorrow because there was some computer fraud. And I'm joking on CrowdStrike, I hope, because I own a lot of it, so I'm not saying anything bad. That is, you put that in your head, ingrain that in your mind, because we're going to play off of it right now. 10,000 out of pocket, infinite upside, can lose it all. Now, I really like calls because I can control the entire, that same 100 shares, but instead it's going to cost me $4.55 per share to control. Oh, I got the wrong. All right. When I built this, it was supposed to be August expiration, but we'll leave July because I wouldn't be doing the July. Well, I'll fix this in a second. For argument's sake, it's fine. It's going to cost me $4.55 to control a share of stock where I can buy it for $108. I have the right, but not the obligation to buy it anytime before expiration on July 17th. If the call goes up, I don't have to buy the stock. I can just sell the call. Here's the P&L curve. I have infinite upside. Yay! All right. I have limited downside. Why risk 8% on a position? All I can lose here is 4%, which is how much my call costs. So my maximum risk on this trade is $455. It cost me $455 to get in. If the stock drops to 50 tomorrow because it gaps down, I lose $4.55. That's it. All right. It's a safe trade. The downside of this call, the stock has to move in my favor the $4.55 plus trading costs, which are nominal today, for me to break even on this trade. So if this stock moves up a lot, a long call is a beautiful thing to have where I capture the upside, I've limited the gain, and I have lower out of pocket. How about a synthetic long? One of my favorite stocks, and use this, or trades, use this at your own risk. And I'm going to tell you what that risk is. If you were to buy CrowdStrike for $10,800, your maximum risk is, drum rolls, $10,800. You have to write a check to your broker, or your money is in the account. Your broker then sells you the stock, and if that stock went to zero, you owe the broker $10,800. Well, he has your money, you just have nothing to show for it. If you did this stock as a synthetic, you have the exact same P&L curve of buying the stock. But in the setting that I laid out here, you're going to get paid $150 to take the trade. Now, unlike that long call, if the stock is the same at expiration, you get to keep the $150. If the stock, in this case, moves less than 1%, you, at worst cases, you break even. If the stock goes to zero, you lose your $10,750, which is less than you would have on the stock because you collected some premium. But you manage this 100% the same as you manage the stock. You don't let the risk run against you. The caveats here is that you can lose a lot of money, just like if you own the stock. Why this is worse than owning the stock is because options have a time, and you may have been correct in your decision, but may drop before it goes up and you end up losing money. So this is a risky trade in the eyes of the world. To me, it's my favorite trade or second favorite trade. I manage it exactly like the stock. The other downside here is you better have enough margin in your account to cover this, or to cover the entire risk or a big part of the risk, or the broker won't let you take it. So infinite risk, infinite downside, and you could get paid, or you would pay a little bit of money to get in. Same stock. Let's look at a bull call spread. So what I see here, and this didn't exactly do the right thing. That's because let me edit this, because this one doesn't look right. And put this down. I'm going to buy a 105. I'm going to sell a 110. I'm going to hit OK, and it prices it. So I have a maximum gain on this trade of $5. That's the spread between my long call at 105 and my short call at 110. Instead of paying for the long call, paying $6, I'm paying only $2.40. The most I can make on this trade is $5 minus $2.40 equals $2.60 times $100 is $260. My gains are capped. The most I can lose on this trade is $2.40. My losses are capped. Okay. If I go back and I look at the long call, which we will in a second, you'll see that I'm getting in for a lot less money. I'm limiting my gain, but I've limited my risk. When do I do this kind of a trade? I might do this trade. Some people do a lot of covered calls. They buy the stock and then they sell a call 1 or 2 strike prices away from the call of the stock. And they keep the premium on the call. And then if they get called away, they made money on the stock. Then they repeat, rinse, wash, repeat. This is a cheap way of doing a covered call, a covered stock, or selling a covered call. You buy a call and then you cover it. It's a great way for generating money and limiting risk. I don't like it because you give up the big money, but I might use it with a lot wider. Let's say that these were expensive options. I could go back to this spread and I could say, you know what? I think my target is 120. So what if I sell a 120 call? Now I have a lot more gain. I can make 985, but the 120 call is cheap, and therefore I'm giving up some of the money I was getting, and now my risk is 515. So it's a good way, in my experience. Wow, we got Giant. Leslie is joined. Author, trader. Wow. I'm honored. Thanks for joining, Les. Honored to have you. This is a way to capture more. I still got controlled risk, but this is when you look at the target and you set your call at the target. So I will do this trade more like that one. What about shorting a put? I hate this trade. Shorting a put means I think the stock's going up, so I'm going to sell you a put. That gives you, not me, you the right, but not the obligation to sell me the stock at $109 or whatever the strike price is. My upside is limited to what I got on that premium, which in this case was $635 for 100 shares. My downside risk is the whole thing, $10,265 if it went to zero. Of course, you're going to manage this and get out if you're losing. Why is this a good trade? This is a trade of rich people. It's a trade of rich people because this stock has to move $6.35 against you, 6% in the time allowed for you to lose money, right? If you wanted to own CrowdStrike and were a rich person and you realize you get to keep that 635 as long as the stock goes up, you make that 635, you can buy CrowdStrike at 6% off. And maybe that's how you're going to accumulate shares. I want to grow my portfolio. I don't like the upside. I don't like the downside. I don't do a lot of selling puts, but I'm honest enough to tell you that some of the richest people in the world have made their fortunes by selling puts. And then my favorite trade, no one ever teaches this at options seminars I go to, and then I go up and they look at it and they go, hey, that makes a lot of sense. And the next year they present it like it's their own. All right, so let me reset some of these prices so it makes more sense. I'm going to buy a call at 105 call, in the money call, at the money, in the money. I'm going to sell a put at $105. And then I'm going to protect it by buying a put at $100. So this trade is a synthetic trade, a synthetic long, but then I bought a out of the money put. So my cost goes up from what would have been $2.50 to $4 and almost 90 cents. But look at what I just created here. My out of pocket is $4.87. In case you don't remember, my out of pocket on the long call was $4.55. So in this case, it's about the same price as buying a call. All right. Going back to this trade. My upside is unlimited. My downside is limited by the price that difference between my short put and my long put. Now, this may not be the world's best example because I'm already $3 in the money on the call and $3 in the money out of the put, which makes the economics look funny. So let me see if I can edit this, and let's do a 110 because that might tell my story better. And by the way, it's not about my story. It's how I'm looking at the trade before I put it on. All right, now I can buy the same position, unlimited upside. It's 110, so I'm $2 out of the money. I'm paying $42 instead of $400 or more. I got unlimited upside, and my downside is limited at $105, so the spread of $5 or $3.30 below where we're at today. This is the trade I would take. I take this trade day in, day night, 24/7, 365. I get all the upside. I have minimal risk. My stock moves to here, 112, 115, whatever my number is, and I close out this portion of the trade. And if I can get 80% of the money, I sold it for $3.40. If I can buy it back for 50 cents, 40 cents, I take it off. Because once I take it off, I got no hit to my margin. My margin looks bigger. It's very hard for me to lose money on this trade. So that was the program. Let me shut that down. I do this analysis on every trade. This was crowd. Here is black line. And I like to end up with this synthetic trade here where sometimes I get a credit and sometimes I pay a little bit. But when I compare it to the long call, thank you, honey. That was to my wife. I'm not being harassing anybody on the line. When I compare it to my long call, instead of paying $535, I'm getting a few pennies back. This here is a spread tool, and I build it. I talk about what my expiration is, what the strike price I want to buy it at, how far do I want, I usually would be setting 5 or 10. The minimum here was 5. And then I drop down into the select types, the long ones that I'm interested in playing. And then they automatically populate. And then I can look down here, what's my maximum risk? What's my maximum profit? And I like infinite profits at the lowest risk. And that's why the Scott synthetic's not here, because that would be because it's not a standard. That would give me the lower risk and the infinite return. And then you could see your ROI on your investment as well. And frankly, why do people buy bull call spreads? They might be limited gain and limited downside, but look at the ROI on your investment. It's huge. So back to the presentation. All right, I saw some questions come in, and okay. What model computer you just buy? I bought another ThinkPad, but I've got 3 for sale, which I'll talk about. Why not do a bull call spread above and a bull put spread for low no cost? I do that. Nothing wrong with that at all. Yes, when I do the synthetic, I'm mitigating some of my time costs because I'm selling and buying at the same strike price. Which part do I sell? I sell the short. If you think about it, it's a long call plus plus a bull put spread, which means I'm selling the one closer to the money and buying a protective one. That bull put spread, the most I can make is the premium, and I could lose the strike price difference. So I want to cover that one. So I cover the bull put. All right. I let the call run and I take off my risk. Stop management. You got to have stop management. I don't put on a trade without knowing this stuff. I have different risk tolerance than you, clearly. I probably make that up, not on where I put my stops, but where I look at position size, how many shares I bought. Every trade I enter with a buy stop, I'm not at my computer. So I usually look a little bit above the closing price or the high of the day. I look at the chart, I look at moving averages, support and resistance, and I try and put the buy stop where it makes sense to me, which is a little bit above yesterday. I also immediately put my initial stop. My initial stop, which is put in place 1 microsecond after the stock goes long on a conditional one cancels the other type of a thing. My initial stop is set based upon why I took the trade and on the chart. I hate to lose money on a trade that was initially profitable. So I've changed some of my plans over the time, over my lifespan. At the initial trade, I set the stop based upon why I took it. If I buy correctly, then my stop should be no more than 8% and preferably much, much, much less than 8%. R is the amount I'm risking. In a sideways and tough market, I'll shoot for a target that's 1R. In a bullish market like we're in, I want 2R. So if my trade moves twice the amount of risk, I declare victory. I take half off, I raise my stop to break even. Now, short of a gap, I have 2R in the bank and half my position at 0R. So the most I'm going to lose on this trade, or my worst return should be 1R. That will keep me in the game and keep me very happy. I let the rest run. When I'm up 4R, which could be 15 to 20% on a 3 to 5%, 3.5 to 5% risk on my initial trade, I will take off the break-even stop and put on a trailing stop. And I like the standard chandeliers that were created for me by Bob Meager as based upon Van Tharp's books. What does R mean? I like using examples and not just talking. Let's just open up a stock. And let's go look at, all right, I like this stock. This is one that was on my buy list that I was starting to build. If you don't have John's stuff, you may not have these charts because they incorporate things that are in John's stuff. So don't get mad at me. So here's a trade that I could be, that's not what I was looking at, is it? I'm looking at 10x genomics. So let's bring it up now. All right, much, much, much better. So let's look at this stock. Stock had pulled back sharply. It was an IPO, I think, not too long ago. It's had a nice uptrend. Remember when I showed you the different trades that I'll take? So here's a stock. Clearly it's been in an uptrend. I don't care if the lines aren't exact. Pull back to support, now it's breaking out. It had a mobile breakout from a squeeze on Friday. I don't like where the high jump is. I don't pay much attention. You see why the high jump here is very short? It's because it's an IPO. Doesn't have history. It only started having 200 days of history here within the last month. So this doesn't mean anything. So I've got a breakout off of trend line support. This red dot's a PSAR dot. This green thing tells me on a new John Person buy signal. And here I had 2 days this week, I had kahunas. That's a big, big story to me when I see multiple kahunas. So if I was to buy this stock, and what I'm doing here, I do on every stock that I trade. So I like to teach. You probably can't tell that. And it kills me that I can't do my live meeting this year because who's going to want to travel to come hear me talk? And I enjoy the camaraderie, so that's why I don't just do it on Zoom. So let's take a look at this. Based upon this chart, it closed at 89.99. The high was 90.03. I know that this red dot is part of the Wells Wilder trading system, and that somewhere out there are people that when this stock crosses above that and then it becomes a green dot below, that probably triggers buy program somewhere, okay? So if I'm going to look down here, the PSAR dot is at $90.43. It closed at $90.03. Because it's trending down, tomorrow the PSAR dot's going to be lower. So I'm going to say, all right, if you're 15 cents above here, if you're $90.15, then I'm going to put a buy stop in at $90.15. So that might be in this area. And then now where am I going to put my sell stop? I have a lot of choices here. The 50-day moving average is at, let's see, I should see, oh, I gotta go back on the price. The 50-day moving average is at 81. That's a little bit too far for me. That would be a 10%, not gonna be there. The lowest in the last four, 1, 2, 3, 4, is this bar right here. Let me take that off. So on this bar, the low was 83.37. So now I'm risking 665 on a $90 stock, a little bit over 7%. I might be willing to set my stop there, okay? And that I decided would be at right below that low, a couple of pennies. So I'm going to put a sell stop $83.35. By the way, I probably wouldn't take that stop. I'd probably look at this trend line and go a little bit below the trend line. But for teaching purposes, this is fine. $6.75 is the difference if I can do math. So my R for this trade equals target 1 equals buy price, which we decided was 90.15 plus 6.75 equals 96.90. Target 2, and I do this every trade I take, whether I buy as options or stock, I don't care. 90.15 plus 6.75 plus 6.75 2R equals 102, 103.65, give or take. So, sorry about that. I'll get you back to where we were 1 second. I hit my mouse when I didn't want to hit to my mouse. So, since I'm bullish on this stock, I would probably want to take half off at T2, which is 103.65. Now, I may decide that's too far, but I'm either going to set my target at either 96.60 or 103.65. R is the difference between that I'm risking. So R is risk. Now, if my stop was closer to 90 to 88, 89, then my R is only about 2 or 3. Then T2 is closer to what T1 looks like with a lower risk. So I want to make sure I get a good return for the risk. Every trade, I do the exact same, and I mark up the charts the same way. And in the old days, I would then make it a PDF and go back and look at it. Once I'm up, I change to a chandelier, and sometime I just get stupid. And what I do when I'm stupid is I take my official stop off, and I look every night. I manually set a stop. If today is Wednesday and the stock trades below my stop, then I put in an order to sell Thursday if it goes below the low of Wednesday. I hate on my long-term holds when I get a big pull down, I get stopped out, and the stock starts back up the next day. So I'll give myself that 1 day, and if it goes back up the next day, I don't get taken out. The trade's not profitable until you close it out. My stop management forces me to take partial profits. And once my stop moves to break even, I should be profitable on that trade. Closing the short arm with my synthetic after move my direction allows me to book profits. In a stock position, I'll take additional profits on the way up. In an option trade, I will roll my long option position up and out, and I will take profits out of the market. Once I will sell a short option to finance this trade. Often I will sell a short option to finance a trade. Every time I do this, I put cash in the account. So I'm trying to figure out how I can best demo this. I think I'm going to pull out, make it a text. So give me a moment, please. So here's what I mean by up and out. Stock is at 40. Stock is now at 60. Stock is at 80. Stock is at 100. Stock is now at 90. So this is a stock. All right, so I start in this position 1. I enter position, stock at 40. I buy a call at a $40 strike price. I sell a put at a $40 strike price. And I buy a put, if I can, at 37.5. All right, that's how I enter that position. Now, we know this price is going up because I'm making an example of it going up. As soon as I have 80% gain in the put trade, I cover it and take off risk. Now let's say this month here was October, and I bought December calls. So now this is December. Now it's December. Stock is at 60, and my call is 21 because it's still got some premium left. So what I'm going to do in December, because I still want to be long, is I'm going to sell my December 60 call, 40 call. I'm going to roll it out. I'm going to buy a February call out, further month out. And I'm going to buy that call at probably, because the premiums are more expensive at the money, for $55. And that trade is likely to net me 21, and I'm just guessing, minus $5.07. It's going to net me about $14. That goes in my pocket. I am now very profitable on the trade and playing with the broker's money. If I want to be a little bit of a piglet, I might say, I rolled up $15. I'm only getting $14 back. I'm being cheated. So I might do this. I might say, my target's 80. So I'm going to sell a $80 call for $1. So now I really netted $15. And I'm sitting with a long February 55 and a short February 80. Okay, now it's February. And hopefully you're getting my point. Now it's February. I'm still sitting in that position. So now it's a little bit before expiration, and my December 60 or my February 60 call or 55 call is worth $25. I want that money in the bank. So I'm going to sell the Feb 55 call. I'm going to have to buy back that Feb $80 call. I could wait for it to expire, and then now, do I want to still be in the position? Sure I do. So I'm going to roll it up. I'm going to buy a April $80 call, because that's about where we are. And I'm going to sell an April $100 call. And I'm going to pocket on this trade probably $25. I'm making money and I still have a position at the money, and I gain if the stock goes up. 80% gain or loss. I'm not, an 80% loss means that stock has dropped a lot and I'm already out of the stock. When I say I'm going to cover that short position on the Scott synthetic, it's assuming the stock has gone up and that short synthetic is now very cheap. If the stock's gone down, I'm probably stopped out already. And now let's just, for shits and grins, let's say that I was smart, but now the stock, we're now May 12th, and the stock is now 120. So I now got screwed because I get to keep 20 bucks, not the 100 and not the whole 40. That's the downside of this position, is you're going to have to, your gains are capped. So I do something that probably I've never seen anybody else do. What I do when my short call becomes close, let's make this 95, because at 120 it's too late. And here's what I end up doing. And this is crazy. I don't know anybody that does it. And actually can't be made because it's after this expiration. So let's just say this is April 12th and it's a week before expiration. So what I have been doing is I spread it out with a butterfly. I buy April 100 calls, equal number. I sell April 120 calls, 2x, and then I buy April, in this case, I'd be 130. These numbers are too big. I wouldn't be using these numbers calls. So what I basically have done, this is how I manage my options, is I have taken the one that it was going to start to be a negative and limit my gains. And this is a relatively affordable trade because in a butterfly, you're buying one, selling two, and buying a cheap one. So I might, for $4, be able to get rid of this call, which is probably worth $7 or $8, and create where I have 80 long, then I got double that short at 120, so I'll make $40 on that, and then I lose on $10 because of I get a short position on half of it, and I can lose 10. I know that was probably confusing, but up and long means I push up the calendar date and the strike date. I can only trade options when the market is open. All right. So I know this is a lot more didactics than you guys expected, so I'm going to stick around for a little bit more. So let's just show you the tools, how I use them. And speaking of tools, I'm selling a few of my current model computers. The Alienware I took off the market because I was still using it. My new one came in. It's a monster computer. It's probably about 2,800 bucks. It's got 2 to 3 years of warranty left. It's maxed out totally, 9th generation i9, 4K, 4 terabytes SSD. I've got a very portable HP Sector 10th Gen i7 with a 1 terabyte and an X1 Carbon 7th generation with a 9th Gen i7 and 1 terabyte. If you buy them, they're reformatted, new windows are on, everything's updated, and you get all my indicators for TOS, TradeStation. They're not proprietary, in hundreds of hours. Just email me if you want them. And if people have ever bought a computer from me, type in that you were happy or unhappy, because people will see I'm a good guy to buy shit from. All right, so very quickly, let's look at the market. I'm going to do this to 12:30. I can't believe I have this many people still here at 2 hours. So, and this is being recorded. Very quickly, top down, how I'm going to look at it. Let me bring up my friend Sagar's tool. This is on my computer the entire day I'm in the market. I can't live without this. And Refinitiv, the Thomson Reuters company, had a glitch this week and it drove me nuts. Because all day long, I'm looking at what percentage of the sectors are advancing versus declining. Obviously, green's advancing. What percent of industries and what percent of stocks. And when you start seeing the markets getting higher and you start seeing the red getting bigger on the stocks and the industries, you know that you've got a divergence there and the market's going to turn around. So this is the greatest tool I have for real-time monitoring the market. It tells me 1 day, 2 day, and 5 day performance on the top, 1 week, 2 weeks, and 1 month performance on the bottom. Sagar changed a little bit to meet my requests. On the inside, I can run this anytime and get an idea of the best and worst performing stocks. Pressure, something he did for me at one point. I can look at which sectors are leading both by rank and how they've done over periods of time. I can look at percentage return, And here's the piece de resistance. Let's say, I don't have a lot of material stocks. I don't have a lot of energy. Energy's turning around. Let's look at materials because it's been up 3% on 5 days. That's pretty impressive. So if I have this highlighted and I hit my gears, oh, Sager, that never happens. Only when I do this live. Unbelievable. What did I do wrong? Well, what it typically is going to do, let me try it from over on this side. I got so many things running. Well, I'm not going to restart it. It would now go into industries and it would just highlight the industry groups that are materials. So let me unselect them all, just do that manually. And then I could have identified the top ones and hit this, and it's going to hopefully, all right, I did something, messed up the macro. Well, it would have opened up stocks, and it would have been, the same thing. Let's go into the industry, sector, materials. Typically, the macro works, it does it automatically. And just so I keep myself honest, I looked at chemicals, materials, chemicals, and containers. So I go over here, industry. So I'm only looking at materials. Go to stocks rather. And then I could come here and say, I want, which materials do I want? So I wanted agricultural chemicals, diversified, specialty chemicals. I can't remember them all. I hit OK. Now just those stocks that fit come up here. Then I hit the magic button. And of course, it's not working today because I got to go reset the macros. And then what it would do, it would bring me the best stocks up to the top. So this is something that's running on my computer all day long. I did a whole video on it not too long ago. It's a great thing to see. So top-down review, I go down to Ron's thing, Market Analysis User Plus. Hit my warehouse view. Actually, I want to go down to 01, warehouse view. I go to my top-down view, which is in my existing, it's an old Ian thing, so it should be in everything. Everybody should have it. Let me find where I got it here. I'm getting tired too, so we're going to definitely stop at 12:30, but I haven't done everything I promised to do. Okay, Sager just told me something that I was doing wrong. So I'm going to close it because I'm going to open up a new copy of it. I mean, this is so powerful that I open up the, okay, it's loading. While I'm doing that, let me bring back up my HGSI. So I put the top-down view on major markets. I'm ranking by raw combo. The Nasdaq's up at the top. No wonder I made money this week. Let me make sure this, okay, it's going to connect. Good. All right, so it's now updated. This is going to change in a second to reflect that. Good. So I'm going to go back here. If I go to sectors, rank them largest to smallest. Oh, say that's got to, I've got to change the date. I'm probably doing this before it has a time to totally run through. All right, materials should be at the top. If I click here, you can see how it's moved up over time. I click this. It's going to show me the various industry groups under materials. Let's rank them by best. Why does it say real time versus 1 day? If the market's open, then it's real time. If the market's closed, that's the current day. If it's Sunday, it's still Friday's data here. I'm interested in the first 4. I hit the people, and it should print out, give me a list of the stocks that are in those groups. And then I hit the stars, and the stars come to the top, and there's no stars. Oh, that figures. So let me undo this. Let's go to a looser screen. And then these are the leaders, and I see things. Blue, these are very undervalued CF looks interesting to me. It's undervalued. It's got good earnings per share growth, so I might want to go play with it. Dow Chemical doesn't have a whole lot of history here. They keep changing around. Good earnings quality. I might want to take, let's take, for example, CF. Let's copy this. This is why I love, this is so cool. And I'm going to go to Vital. I'm going to paste it in Q. And I'm going to hit this here. And it will populate, tells me what it is. It's a fertilizer stock. Gives me some of its fundamentals. And now it's going to print out its peers, similar companies. It's now going to print out, fill this stuff here so I can understand about the group over the last couple of days. So the valuation, it's undervalued. This isn't, I'd rather this be blue, good earnings, not much opportunity for a short squeeze. You can see the majority of the groups, advanced decline was positive of these stocks. And if I want to look deeper at these, I have the fundamentals just popped up on these. And if I want to look for the most undervalued stocks in the group, it's this 3. And I might want to take a look, maybe it's CMP. But I just narrowed down my list. And then over here, I have to go to the right far to get the symbols that will work in TradeStation. Copy. I could go down to TradeStation, go to my Q workspace in TradeStation. These are, just dump these in here and look at them. CF, uptrend, auto-generated trend line. Could be a reversal candle here. It looks like it's turning up. That's a John Person sell signal, but we'll see. I look on, this is on the weekly, on the daily. It had a stretch, which means it went too far to the downside, got right down to support and is moving up. I have a little bit of resistance perhaps at this, this line here. Then I got a nice little room here. This is interesting to me. I wonder if this actually counts as a go with flow setup. This candle is a little bit indeterminate for me. It's got wicks above and below, as does this as kind of a doji. That's the only negative that I see there. The CMP, again, looking at Q tools, it's got resistance right here on the weekly, so I probably would pass on that one. And Mosaic, again, I don't like the shape of these candles, but remember the market sold off at the end. This one broke above resistance, didn't have on a ton of volume. This might be interesting. I might put those on a watch list. That's how I do it with Edge. Great tools, great stuff. So I know I'm running out of time. I'm going to just finish the top-down approach, and then I'm going to record a second video after I go out and after you can go enjoy your holiday of my bottoms up, and I'll post both of these later tonight. So back on my top-down review, I see the Nasdaq's, the strength, the VIX, bonds, silver, dollar on the bottom. That tells me I made money in the market this week because that's a growth investor's dream. I then look at my favorite indexes to get a sense of what the market's doing. So I look at the S&P 500. Let me move things back to where they belong. And I want this to be an index view. Then I open up a new charting window, which will be the weekly. Let's get more. So as I look at the S&P 500, we had a peak here, pull back, run up, fail, run up, right into the chandelier stop. I am concerned that this market is toppy, and I'm concerned that we're going to come down. The good news is I've got a 50-day moving average here that's about to give a golden cross, and I got a 200-day moving average. So, you know, I'm concerned about this coming week, but we may live in this box, and that box is totally fine. I could be totally wrong. We can just break out and go to the moon. But I think we're at resistance here on the S&P, but boy, we got a lot of support down in this area here, don't we? That actually makes me feel happy because I like to see support. I don't want utilities, I want industrials. The 30 stocks we care so much about. Also sitting here with a lot of resistance. Note that on Friday, it traded up to the 200 and failed. Here's its chandelier stop. So am I bullish or bearish on the Dow? I got to be bearish here. But again, I've got a 50-day moving here. I got an area that's been supported in the past. So, maybe we have a modest pullback and we live in that zone. That doesn't mean, Ian always taught us a high road. High road says we're just going up to the moon. Low road says we're going to go down. I think the most likely thing is we go down and we chop around and then we break out to go higher. But that's just my three options. And I don't know which way it goes. If I did, I'd be a liar. So that's how I'm going to watch it. But my expectation is that we're at a bearish point there. What doesn't look like the others? Well, before I do that, let's show you the Russell. The Russell also looks to me like it's having a very difficult time breaking above the 200. Here's the chandelier stop. But it too has some areas that would probably be support down here. You go back to my box. So I like boxes, and I really think it's in this box until proven otherwise. What looks different than the others is the Nasdaq. And the reason why I made a lot of money this week, and I'm sure so did you, is because the Nasdaq's in a major bull run. It has clearly started to decelerate. It is near the top of its high jump. It had a red candle high reversal on Thursday. So it is not without risk, but it is clearly the most beautiful of them. Since you guys are growth traders, you wouldn't be following me. If you look at the IBD 50 ETF, which is a managed ETF, it is in a nice uptrend. Looks a lot like the Nasdaq. And what had been leading before IBD breakouts, which again looks like the Nasdaq. If I look at the dollar has, it's sideways. I mean, a lot of people are bullish about the dollar here, but the dollar is sideways. If I look at the VIX, it would be nice if the VIX came back to where it used to live down here at 15, but it did pull back to the 200. Now, if I was looking at a stock and I pull back to the 200-day moving average, I might think there's a chance that that stock could bounce. So I'm going to be watching the VIX to see if the VIX doesn't bounce here, which would have negativity on the market. Gold, which has multiple values, is at its highs for multi-years. Little bit of a pullback the last couple of days, but at its highs. It's been strong. Silver, strong, more sideways move. And then gold miners had lagged. I would like to think they were going to break out, but actually, I have a thing I do when I see this pattern. And what this pattern is, I got a lot of interest in going long. When I take out the top of that candlestick, gravestone doji, whatever you want to call that, shooting star, and I would go short if I take out the bottom of this one. So I probably won't touch gold miners until it declares up here or down here. Let's see, what else do I like to do? Next thing I would do is go to industry groups number 7, hit the warehouse view, and just to give you a sense of the bullishness in the market. I cannot believe this many people are here 2.5 hours in. Holy shamoles. I'm ready for a break too, folks. 2-day force up, 71 groups to the upside, 2-day force down, 9. Very bullish short term. This was a super strong week. 5-day force to the upside, 65. 5-day force to the downside, a little slower mover, 39. So it's a very short-term story. We had a great run this week. It was strong seasonality. We talked about it last week. Some of my favorite groups are showing longer-term weakness: biotech, banks, internet media, mortgage finance, generic pharma, some of the things that have been making money this year. 10 more minutes and I'm done, I promise, because I won't have a voice left. So 2-day force, I rank by raw. Can you say Tesla? Let me change the view here to a stock view. Tell you about what I'm looking at here. Up on the top, I have my Hindenburg Omens. Myrna's husband, Norman Fosbach, was very instrumental in to the people that developed this, has his own tools. Very smart guy, enjoyed conversations with him. I like the Hindenburg Omens because it just gives me a sense of when I need to be careful. They're calculated on the market, but the market is a market of stocks. So let's just put the NYSE in here just for giggles and grins. So I look for things like the Hindenburg Omen to give me a clue before this happens. 25% of the time, they probably work. I have dropped the daily bongo because it's too fast. I just look at the weekly bongo that gives me the dominant trend. Here is the high jump with a red candle high and green candle low. Then I look at Bible gap ups, which you won't see on the NYSE, squeeze, mobile breakouts. Down here, I got the John Person indicator, the Person market catcher, pocket pivots, on balance volume with eurekas and phoenixes, and then volume. On my chart, I have a 200-day simple in red, a 50-day simple in blue, and a 17-day simple in green. I have an 8-day exponential in magenta. These lines represent a chandelier stop, not the last conditional change, and the red dots are the PSAR. So if I look at Tesla, another to infinity and beyond, a lot of bullish sentiment here. I can't chase stocks. It doesn't meet any of the patterns that I showed you that I buy. If you own it, God bless you. You're making a ton of money. Woulda, coulda, shoulda, but I'm not. Hard for me to justify the price with the fundamentals, but we know that right now the street loves Tesla. Could have bought it here on this pullback. I'd look for a pullback before I would chase it. NIO, my neighbor is not going to be happy because NIO looks just like Tesla. You just take away 3 zeros. It broke out as well. NIO is a Chinese electrical vehicle. You know, if the Dems take control, they're going to change all of us to e-vehicles by 2035, I believe, which means those gas combustible cars in my garage are going to be in trouble. But NIO is in the same group. I never look below the index. Commercial vehicles, that's interesting. Workhorse Group, this is a Robinhood stock. It's been around for a long time. They announced a big contract. What do? Designing, developing, manufacturing, selling medium-duty trucks. I think they've got, they have an electrical truck. And they went crazy with some partnership. Again, how do you buy this stock? It reminds me of Plug, Lake, and all the Alpha Protects, these giant runs up on volumes that are ridiculous. 120 million shares traded. Back here, this stock was trading 1,898,000, 2 million, 800,000, 2 million, and now it's trading 50 to 60 times. Too much exuberance for me. $10 says the stock comes down, goes sideways before it goes higher. But that's, didn't tell you the time frame, so I'm guaranteed to win that bet. Third group down, e-commerce discretionary. Well, you know, I'm a happy man when Amazon's up because it's my #1 position. I only use 1,000 shares in my model account. The rest are elsewhere. But I will buy puts and calls along the way. Amazon is at an all-time high. Not a very bullish candlestick, red candle high at the high jump. If you had to ask me what's Amazon going to do this week, it's going to go down. Earnings are the 23rd. It did have a weekly high closed doji. That does not count when you're in an uptrend. It only counts in a downtrend. So Amazon, super strong week. The enthusiasm in the Canaries is just crazy right now. Alibaba, again, it's not extended yet, but it's getting there. Big gap up on Friday. Pinduoduo, we talked about this a few times. It's hard for me to buy this thing except for on pullbacks. Pullback. Maybe I should have bought it on Wednesday. Very extended, had red candle highs at high jump, doesn't make any money, but it's in the right group. Netflix set an all-time high on Friday and sold off. Guess that's a bearish cloud cover. We'll see if it means it's going down. Its earnings are in 2 weeks. Amazon is the following week. Overstock looks like the others. Beautiful run. Again, you could buy it anywhere down on pullbacks. Where do you set your stop if you buy it here? Lowest bar 4 days ago would be 20% away. Even here is 10% away. It's just hard for me to manage that in a way that I can take any size and not carry an exuberant amount of risk. And eBay breaking out. In the right industry groups, you got great stocks. Renewable energy, Plug Power. All right, let me show you what I mean. I don't go back far enough in this view. Never mind. This stock has a tendency to run up, have the volume go cuckoo and come back down, run up on news. Here the volume was 69 million, 5 times average volume, and come down. Here it is again, running up. It's a Robinhood stock. My son's buying this stock, 38 million shares. Maybe one day these momentum guys will be right and will actually continue, but every other time it's come back down. I can't buy that. Ballot Power has been on the top of the list for a while, but again, it's extended. Tough to buy right here. Application software, this has been where the market has been. I've got a bunch of these, and that's helped my portfolio. Doc, you signed. Can you buy this stock here? I can't, but it probably goes higher. Look at the fundamentals. It doesn't make money. It's on fire. It trades at a PE of what? Oh, it doesn't have one because it doesn't make money. Duh. What a great run. Buy it on pullbacks. There are places you can buy the stock. You just, to me, I can't buy it here. Zoom. Too far gone for my taste. Twilio. To show that I'm just as bad as everybody else, I sold my Twilio here and I missed out on the whole run. It happens. It just didn't work at the time I gave it. I saw this signal and I got stopped out when it failed at the 200. See, I'm still in. You could have bought it this week here, but I wouldn't buy it here. In fact, it looks to me like it's probably getting tired, and maybe I'll close that position. There was a couple of questions I want to get to. The overflow, I'll go through Roy. Yes. How do I find them when they're just starting out? I look for my pattern. I look for a stock. I don't care how long the stock's been around. I look for a stock that's pulled back to the 50, that free parking. I look for a stock that's pulled back and is broken above support. And really, the truth is, I want to see one of my patterns. This is what I bought, Tandem. This is where I buy C. This is where I buy a sideways stock. Ha, coughing. Beginning to yawn. Yeah, I know. It's time to shut it down. Very happy buying a Jeff computer. See, free advertising. All right. It's 12:26. Guys, I'm tired. I owe you the bottoms up review. I will do that sometime this weekend. I will post both of these. There is a way that you can support me. I want to look at CYDY. Here's how you're going to support me. Please take a look at HGSI if you don't use it. Okay? Take a look at Cigars Tools if you don't use them. Take a look at John Persons if you don't use them. These are all people that have become friends of mine. I get nothing, as I've said, I got the wrong ticker, CYDY, CYDY. I don't get anything if you buy their stuff, but I like supporting people whose stuff I use and I make money at. If any other questions, I think everybody's going to sleep on me. If you sell a call, against your stock and the stock blows through your short strike, do you ever roll the call up and out to keep the trade going? Absolutely yes. Absolutely yes. And sometimes I'll use the butterfly strategy and get it way away. Absolutely yes. All right, guys, you probably never had that much in such a short period of time. Hey, Gary, I love your comment. Thanks, everybody. I'll post this. I'll do the bottoms up later. If you like this, the next time you see I'm doing a live meeting, maybe I'll do one virtual. I'll take the same thing, do it over 10 hours and over 5 days and see if we can't teach you how to make some money. Goodbye, everybody. Thanks for coming.